how do interest rates affect stocks? We have talked about how the Fed tends to move interest rates in tandem with how the economy and how inflation is moving. And if you haven't watched the show before, we have that cycle up in front of you. But today I want to dissect further how the interest rate cycle affects the stock market, where we find ourselves right now, and what could happen at the next FOMC meeting if they do hike interest rates once again. And here we'll start off with the broadest scope, essentially the 10,000 foot view, and then we'll get closer and closer to the picture, so to speak. When rates rise, stocks tend to fall and vice versa. There's essentially this knee-jerk reaction whereby when you have the economy growing and then out of that inflation rising and then out of that the Fed needing to come in and hike interest rates to calm inflation, the knee-jerk reaction from the stock market is contracting. And that's what the Fed is essentially going for. They don't want to cause a stock market crash, but they want to slow down that inflation, which not only slows down consumers spending money, but they want to slow down companies growing too much and hiking the prices for stuff. And that's what causes the inflation in the first place. And so it should come as no surprise that the knee-jerk reaction from stocks to higher interest rates or interest rate hikes from the Fed is to move a little bit lower. But what we're seeing as we kind of move from the initial part of that phase. You'll remember that the first interest rate hike that the Fed committed was now over a year ago, I believe. Do the stocks that make up our economy still respond to interest rate hikes now a year later in the same way that they did to those first rate hikes, which was rates higher, stocks lower, because inflation is falling and we're kind of moving out of this phase into the potential for Fed rate cuts by the end of the year. And so you're seeing that though we are still due to see higher rates from the Fed at their next meeting, it seems like the cycle is turning a little bit and the market could be getting ahead of that cycle turning because we've seen the correlations turn. Stocks are now positively correlated to interest rates. For all of 2022, stocks were negatively correlated to interest rates, meaning as the Fed was starting to hike and continuing to hike above 2, 3, 4%, the reaction was higher rates, lower stocks. That's really worn off here. And this has also happened in the past. You can look at price data around past instances of high inflation leading to higher interest rates. And you'll see that the stock market has that knee-jerk reaction of moving lower for the first few months or so. But you can look back at the 80s, for example, when inflation was high for years. And after the first year of high inflation and the Fed back then hiking interest rates, they got all the way up to double-digit interest rates in the 80s. After that first year or so, stocks actually bounced back, and with interest rates still being high, 7, 8, 9, 10% even, stocks were having 10, 20% up years amid high interest rates. And we're starting to see these correlations turn. We're starting to see maybe shifting out of at least that initial phase of interest rate hikes where bank stocks have a 0.66 positive correlation to interest rates. Oil stocks as well, small cap stocks, there with the Russell positive, almost a 0.5 correlation there. And you're seeing that gold used to in 2022 at the onset of inflation, gold was moving higher with interest rates. Now gold moving in the opposite direction here in more of a traditional interest rates higher, stocks higher, essentially risk on movement, and then risk off when everybody's feeling fearful. Interest rates are moving lower, stocks are moving lower, and actually gold and Japanese yen, which are traditional flights to quality, are moving higher. And actually today, Tuesday, May 2nd, is one of the great examples of exactly that. You're seeing the stock market move lower to the tune of, depending on which index you're looking at, 1% to 3% lower. And you're seeing Japanese yen up significantly today, gold up significantly today, and interest rates down as well. So we're out of that knee-jerk reaction phase of higher rates, lower stocks, where actually the two are positively correlated. And you're seeing those traditional flight to qualities like gold and yen being negatively correlated to interest rates. And when did this flip? Well, the correlation changed here in the early part of 2023. And of course, there's going to be something contextually that causes this flip. It's not like a matter of, I bring up the 80s, and it's not a matter of, 12 months have gone by of higher interest rates, and so now stocks will be positively correlated with interest rates. It is a little bit of that, like I say, getting out of the initial knee-jerk reaction phase, but also there's always a contextual piece, a conduit. And what changed was a little over a month ago, we started to see a little bit of fear be put in the stock market. The stock market fell in 2022 mostly because of interest rates being raised. You'll remember that stock volatility wasn't screaming off the page for 2022. There wasn't really a lot of fear in the market, but here in 23, we're seeing substantial fear around the banking crisis, around the potential for this debt ceiling not to be resolved before the U.S. Treasury runs out of money and potentially has to default. And so now, with those fears coming in around February, March of this year, that's where you saw the correlation change. And you look at this chart of stocks in red versus interest rates, and the first part of it here throughout 2022, you see stocks moving lower, lower, lower as interest rates incrementally move higher, higher, higher. And then I have circled the correlation change. And since then, it's been pretty much one-for-one activity. Stocks higher, interest rates higher, stocks lower, interest rates lower. And now you would almost see, if the Fed comes out and hikes and says, hey, we're looking at hiking in the future, something that's been bad for stocks in 2022, that might be seen as a vote of confidence for stocks here. Maybe technology stocks won't like it as much as banking stocks or energy stocks or material stocks, but the market at large, you can't deny the trends that we've been seeing here, the correlations that we've been seeing, whereby higher rates have been confidence boosters for the stock market. And we're getting into this more traditional space. Whenever the Fed goes from low interest rates to hiking, or from high interest rates to cutting, there's always some turbulence and some wacky activity. And I think we saw that for the last year, and we're maybe getting out of that a little bit here and seeing more of a traditional piece, whereby you have your risk on markets like your stocks and your copper, your crude oil, more industrial commodities, and you have your risk off markets that do well when fear is afoot, which is your yen, your gold, your stock volatility, your silver. And then you have here interest rates. And I threw in Bitcoin just because Bitcoin has been a weird one as well, that can kind of straddle the line. They can play both sides of this, where they're doing well when we're feeling risk on, and they're moving higher when fear is afoot, like last year with inflationary fear. Although, like I say, it wasn't the biggest fear in the world. Interest rates were doing well, we're moving higher at that time. And Bitcoin, it's been a little bit similar as well, where it can play the risk off game, where it is, seen as a flight to quality, as it's been seen a little bit with this banking crisis, but it can also move with stocks there. And it's been interesting when you see fear enter the market. Not only do correlations between stocks go closer to one, but you tend to see the correlations between risk on markets and the correlations between risk off markets go closer to one as well. It becomes very binary. And again, today, a great example of that, is fear up, then the risk on markets are doing bad, the risk off markets are doing well. Is fear relatively down today, then the risk on markets are doing well, risk off markets are doing poorly. And it'll be really interesting to see with the interest rate decisions that are coming out of the Fed in the coming days and months throughout the rest of 2023, how they continue to affect the stock market. But for the time being, the correlations, all the numbers and everything telling you that higher interest rates, vote of confidence for the stock market, and the two are tending to move together at this period.